Welcome to the deep dive. Today, we're jumping into something really fundamental for, well, anyone looking to launch a business: securing financing.
It's definitely a big one.
Yeah, and we've got this great source, Essential Strategies for Financing a Startup Company. Our plan is to really unpack the key strategies here, hopefully giving you a clearer picture of how to get that vital capital.
Absolutely. Because financing, it's the engine, isn't it? You can
Yeah.
have the best idea in the world, but without fuel.
Exactly. You need it to get off the ground. The source highlights this while covering those initial costs. Things like, operations, marketing, figuring out your market, actually building the thing. It adds up fast.
It really does. And it's not just the startup phase. Financing is critical for growth, too.
Hmm.
Expanding your market presence, building your customer base.
Bringing on talent.
Right. Hiring people, improving the product, ramping up marketing, all that needs funding.
And maybe the most crucial point the source makes is having that buffer, that safety net.
For the unexpected.
Yeah, because things rarely go exactly to plan, right? Maybe sales are slow to start or costs pop up you didn't foresee. That cushion can literally save the business.
It prevents those short-term cash flow problems from becoming fatal. It gives you room to breathe, to pivot if needed.
So the source mentions there are quite a few different ways to get this funding. Where should we kick things off?
Well, a very common starting point is bootstrapping.
Right, pulling yourself up by your own bootstraps. What does that actually look like for a startup?
Essentially, it means funding the business yourself, using your own savings, maybe credit cards, or just pouring any early revenue right back into the company, being super lean.
And the big advantage there, I imagine it's about control.
Exactly. That's the main draw. You keep full ownership, full control, no outside investors telling you what to do or taking a slice of the pie.
Makes sense. But what's the flip side? What are the limits of just bootstrapping?
The main limitation is, well, your own pockets, or how fast the business itself generates cash. If you need to grow really quickly or jump on a big market opportunity, bootstrapping might just be too slow. You might not have enough capital when you need it.
Okay, so bootstrapping can only take you so far, potentially. What's next? The source talks about angel investors.
Right? Angels.
Uh,
These are usually wealthy individuals who invest their own money into early-stage companies.
and they're looking for...
Typically, they invest in exchange for equity, so ownership shares, or sometimes something called convertible debt, which is basically a loan that can convert into equity later on.
So it's not just free money, but they bring more than just cash, usually.
Oh, definitely. That's a key point. Good angel investors often bring valuable industry experience. They might have built businesses themselves, plus their networks.
Connections.
Exactly. Connections to potential customers, partners,
Yeah.
maybe even future investors down the line. That mentorship and network access can be invaluable.
So how do you attract one? What do they need to see?
You need a strong pitch and a really solid business plan. Angels need to be convinced that your startup has real growth potential and, a clear path to making money. You've got to sell the vision.
Okay, moving up the funding ladder, the source brings in venture capital, or VCs. How is that different from angels? Sounds bigger.
It generally is. Venture capital comes from VC firms. These firms manage pools of money from various sources, institutional investors, wealthy families, etc., and they specifically invest in startups they believe have massive growth potential. High risk, high reward.
And they usually invest larger amounts than angels.
Yes, typically significantly larger sums.
Yeah?
And they also invest in exchange for equity, often a substantial chunk.
So the huge benefit is access to serious capital for scaling up fast.
That's the main one. It allows for major expansion, big R&D pushes, aggressive marketing campaigns. Plus, VC firms often provide pretty hands-on strategic support, more structured guidance than you might get from a single angel.
But there are trade-offs, right? The source mentions some considerations.
Definitely. The big one is dilution. Because you're taking a large investment, founders often give up a significant percentage of ownership.
Less control.
Potentially, yes. And VC deals come with complex terms, legal agreements. These can influence future decisions, the direction of the company. It's a partnership with serious implications.
The source really detailed how VCs help startups scale. Beyond the money, what's that strategic support look like?
It can be quite involved, helping optimize business processes, figuring how to scale operations efficiently as you grow, navigating market challenges, and their networks are usually incredibly powerful too, opening doors to major partnerships, big customers, and importantly, setting you up for future, even larger funding rounds if needed.
Okay, let's switch gears a bit. Crowdfunding. Platforms like Kickstarter, Indiegogo, lots of people know those names. How does that fit into the financing puzzle?
Crowdfunding is, well, just like it sounds, Raising funds from the crowd, usually small amounts from a large number of people, typically via online platforms.
What are the upsides for a startup using crowdfunding? Seems quite different.
It is. A major benefit is accessing capital without going the traditional route of banks or VCs. That can be great for really early ideas or maybe niche products.
But it's more than just the money, isn't it?
Oh, absolutely. A successful campaign is fantastic market validation. If loads of people pre-order your product or back your idea, that proves there's real interest.
Creates buzz.
Exactly. And it builds a community around your product. Early adopters who become advocates, you get direct feedback too, which is gold for improving the product. Plus, the marketing exposure can be huge, raising awareness, maybe getting media attention.
So it's like funding, market research, and marketing all bundled together. Interesting. What about the old-fashioned way? Bank loans.
Still an option, for sure. A bank loan gives you a set amount of capital up front, and you pay it back over time with interest. Standard debt financing.
What do banks typically look for from a startup? Is it easier or harder than getting investors?
It can be tough for early-stage startups. Banks want to see a really strong, detailed business plan showing you can definitely repay the loan. And crucially, they often require collateral.
Assets they can take if you default.
Right. Which a new startup might not have much of, so that can be a barrier.
But the big plus side, compared to angel or VC funding.
No dilution. You don't give up any ownership. You just owe the bank money.
Yeah.
Once it's paid back, the obligation is done.
Now, the source also points out that just getting funding, no matter the route, isn't always smooth sailing. There are limitations, challenges.
For sure. The biggest hurdle, especially early on, is just raising any capital. Convincing investors or lenders when you might just have an idea, maybe limited traction. It's hard. They want to see potential stability or return.
And even if you do get funding, potential issues can crop up.
Yeah, like we touched on with VCs losing some control, giving up ownership. That's a big one with equity financing.
And the agreements themselves.
Funding agreements can sometimes have restrictive terms, things that limit your decision-making power. And then there's just the pressure, high interest payments on loans, or investor expectations for rapid growth. It can strain the finances and the team.
It really sounds like you need a solid strategy. Which brings us to the business plan. The source hammers this point home. Why is that plan so critical?
It's basically your startup's roadmap, laid out clearly and persuasively. It details your strategy, your vision, and crucially, your financial projections. For investors or lenders, it's often the first serious look they take to judge if your business is viable.
What parts of the plan really matter most for convincing funders?
Well, first, your value proposition and market opportunity. You have to clearly show what problem you solve, who you solve it for, and that the market is big enough. Prove there's demand.
Makes sense.
Then the financials. Realistic projections for revenue, expenses, profit, and a very clear explanation of how much money you need and exactly how you'll use it. Transparency builds trust.
And what about the people involved?
Absolutely critical, highlighting the team's experience, their qualifications. Investors aren't just betting on an idea. They're betting on the team's ability to execute that idea. A strong team makes a huge difference to their confidence.
Right, the jockey, not just the horse. Okay, finally, the source links all this to secondary market research. How does looking at existing data help secure funding?
Secondary research digging into industry reports, market studies, competitor info gives you the essential background context. It helps you understand market trends, industry dynamics, who your competitors really are.
So it grounds your plan in reality.
Precisely. It helps you build a credible business plan and realistic financial projections. It shows you've done your homework.
How else does it help in the fundraising process?
It helps you understand industry benchmarks, like how much funding do similar companies raise? What metrics do investors in this space care about? This lets you tailor your ask and your pitch to what investors expect.
So you're speaking their language.
Exactly.
Yeah.
It can also help you spot market gaps or niches your startup can target. And it's vital for risk assessments, identifying potential risks, and showing investors you have strategies to deal with them.
Any other benefits?
Yeah, looking at past investment trends, who's invested in what can help you target the right investors and shape your funding plan to match current preferences. It just increases your chances all around.
So that research isn't just academic, it's a really practical tool for actually getting the investment. Okay, so wrapping up, we've covered quite a spectrum. Bootstrapping, angels, VCs, crowdfunding, bank loans.
A whole toolkit of options. And we've seen how crucial that well-researched business plan is as the foundation for accessing any of them.
Absolutely. And as the source emphasizes, there's no single right answer. The best financing path really depends on your startup's specific situation, its stage, its long-term ambitions.
Which really brings us to the final thought for you, the listener. Looking at your own ideas or your venture, which of these strategies feels like the best fit right now? And maybe more importantly, how are you going to stay informed and adapt as this whole startup funding world keeps changing?
Yeah, it's definitely a dynamic space, food for thought.